Cathie Wood is buying Sofi, and you might want to load up some shares as well, so sit tight as we go through why Sofi is such a good buy at the moment. But before we do that, subscribe to our channel, $1 World, for regular Sofi stock updates. The fintech landscape is currently saturated with innovations such as neobanks, peer-to-peer payment platforms, and buy now, pay later services, posing a formidable challenge to traditional financial institutions like Wells Fargo and JP Chase, which rely heavily on physical branch networks. In contrast, newer entrants are reshaping the industry by offering financial services exclusively through digital channels. Sofi Technologies has emerged as a pioneer in the realm of digital banking. In its recent third-quarter report, the company demonstrated exceptional performance, garnering the attention of ARK Invest CEO Cathie Wood, who acquired nearly 500,000 Sofi shares. While the earnings report highlighted several positive indicators, concerns persist, potentially contributing to the current valuation. Despite these concerns, the situation presents an intriguing prospect for long-term investors willing to weather short-term fluctuations. The shift toward online financial services, underscored by Sofi's success, signals a broader trend in the industry. Investors may view the current dip in valuation as an opportune moment to capitalize on the potential for future growth and innovation in the digital banking space. As the industry continues to evolve, Sofi Technologies could position itself as a lucrative investment for those with a strategic, forward-thinking approach. Sofi, a prominent player in the fintech arena, exhibits a unique business model that requires a nuanced evaluation beyond conventional financial metrics. The company's susceptibility to macroeconomic shifts, particularly in the context of prevailing high interest rates, introduces an additional layer of complexity. Furthermore, the substantial portion of Sofi's business tied to student loans, subject to legislative interruptions, makes quarterly result analyses more intricate. Stepping back to survey the larger landscape, Sofi operates on a flywheel business model, aiming to attract users and subsequently cross-sell a diverse range of financial products and services. The efficacy of this model hinges on the retention of satisfied users, enabling Sofi to allocate resources away from continual customer acquisition and retention efforts. At a glance, Sofi appears to be executing this strategy successfully. The platform reported approximately 7 million users, making a robust 47% year-over-year increase. Impressively, the company achieved its 10th consecutive quarterly revenue growth, with Q3 figures reaching $531 million, a substantial 27% year-over-year uptick. One noteworthy development is Sofi's foray into the mortgage segment, exemplified by its acquisition of Wyndham Capital Mortgage. The integration seems fruitful, as evidenced by its 64% year-over-year increase in home loan volume during Q3. This move diversifies Sofi's portfolio and taps into the flourishing mortgage market. The student loan segment, a significant component of Sofi's business, witnessed a doubling of origination volume from the previous year. This growth is particularly notable given the legislative pauses affecting student loan payments, underscoring Sofi's resilience in navigating regulatory challenges. Expanding its technological footprint, Sofi's technology segment reported a 6% year-over-year revenue increase. The company strategically onboards new customers through acquisitions, such as Technisys and Galileo, showcasing an adaptive approach to stay at the forefront of financial technology trends. However, despite these commendable achievements and record revenue generation, there seems to be a lingering impediment preventing Sofi's stock from experiencing exponential growth. The undisclosed factor adds an air of uncertainty, leaving investors curious about the trajectory and untapped potential of this fintech giant. In summary, Sofi's multifaceted business model, spanning diverse financial services and marked by strategic acquisitions, positions it as a dynamic force in the fintech landscape. While the company demonstrates resilience and growth across various segments, the undisclosed factor introduces an element of caution, emphasizing the importance of a comprehensive evaluation for investors considering the long-term prospects of Sofi Technologies. Investors should exercise caution and not be swayed solely by impressive revenue figures, as a comprehensive analysis of Sofi's income statement and balance sheet is imperative for a nuanced understanding of its overall business performance. A closer examination of the items beyond revenue on Sofi's income statement reveals a notable concern. The company has a track record of operating losses. In the quarter concluding on September 30th, Sofi reported a net loss amounting to $267 million. It's crucial to highlight a significant aspect of this financial scenario. Sofi recorded a one-time goodwill impairment charge of $247 million in Q3. If this non-recurring charge is excluded from the income statement, the net loss for the quarter would have been approximately $20 million, a considerably more manageable figure. However, Even when considering the 9 months leading to September 30th, SoFi's reported net loss stands at $349 million, and on an adjusted basis, accounting for the goodwill impairment, it totals around $102 million. This insight underscores the importance of delving beyond the surface of revenue figures and considering the underlying financial health of the company. Investors must be cognizant of the nuances in SoFi's financials, including one-time charges, to make informed decisions about the sustainability and profitability of their investment in the long run. Enjoying the video so far? Be sure to join our Discord community to connect with other like-minded investors. Looking at the SoFi stock, as of the current snapshot on November 14th, 2023, Sofi Technologies Inc. or SoFi is trading at $7.06 USD, reflecting a day's charge of positive 2.38%. The stock's day's range oscillates between $6.72 and $7.11 USD, while its 52-week range spans from $4.24 to $11.70 USD. With a market capitalization of $6.65 billion USD and 598.74 million outstanding shares, SoFi exhibits a beta of 1.92, indicating a higher volatility compared to the market. The company's earnings per share, or TTM, stands at negative 45 cents USD, and the forward price-to-earnings ratio, or NTM, is relatively high at 102.97, suggesting investors may be paying a premium for future earnings. The trailing 12-month EBITDA is $441.05 million USD, reflecting a measure of the company's operational efficiency. Despite the positive aspects, certain financial indicators warrant careful consideration. SoFi's return on equity, or TTM, is negative 5.53%, indicating a negative performance in terms of generating profits from shareholders' equity. The debt-to-equity ratio, or MRQ, is 116.34%, signaling a relatively high level of leverage. Analyzing short interest reveals that as of October 31st, 2023, there are 117.49 million shares held in short positions, constituting 13.26% of the float. This suggests that a significant number of investors are betting against the stock. Key financial ratios provide additional insights into SoFi's valuation. The price-to-earnings ratio, or P/E ratio, indicates that investors are willing to pay more for each dollar of earnings, reflecting the market's confidence in the company's future prospects. The price-to-book ratio, or P/B ratio, and enterprise value to EBITDA ratio, or EV to EBITDA ratio, are metrics investors use to evaluate the stock's relative value compared to its book value and cash flow, respectively. Analyst ratings for SoFi are mixed, with 9 strong buy, 12 buy, 7 hold, 3 sell, and 1 strong sell. This divergence in opinions underscores the uncertainty surrounding the stock. While SoFi is positioned as a growing fintech player with innovative offerings, the company is not yet profitable and faces stiff competition. Investors should weigh these factors carefully and assess the risks before deciding to invest in SoFi stock. The dynamic nature of the fintech industry and the potential impact of competition make SoFi an intriguing yet challenging investment opportunity. Talking more about SoFi's position in the market, despite Sofi Technologies grappling with increasing losses, it deserves recognition for making substantial progress in mitigating its financial challenges when compared to 2022. The company's adjusted net loss of $102 million for the first 9 months of the year stands out as a significant improvement from the prior year's $280 million. Notably, the Q3 loss of around $20 million brings SoFi closer to the break-even point than ever before. A comparative analysis against key players in the fintech market, including Upstart, PayPal, Block, Adyen, Bank of America, Wells Fargo, and JP Morgan is depicted in the chart. Despite differences in size, maturity, and product depth among these entities, the chosen metric for valuation, the price-to-book ratio, or P/B ratio, underscores SoFi's positioning, with a P/B ratio of approximately 1.4. SoFi is situated near the lower end of the spectrum, aligning more closely with traditional banks like Wells Fargo, JP Morgan, and Bank of America. This reflects the market's perception of SoFi as a bank, despite its status as a digital banking pioneer. The chart prompts a nuanced understanding of SoFi's identity, portraying it more as a technology company than a conventional bank. This analogy draws parallels with how Tesla is often viewed as a software business rather than solely an automaker. SoFi's strength as a technology platform, facilitating rapid global outreach, distinguishes it from legacy banks, enabling efficient engagement with a broad audience. Despite a history of operating losses, the company is making strides in narrowing its cash burn, signaling a positive trajectory. With SoFi stock experiencing a 70% decline from its all-time highs, the current scenario presents an opportune moment for dollar cost averaging to attractively low levels. The belief in Sofi as a bargain is rooted in the convention that its business model is effective and that over time, more investors will come to recognize the inherent value and potential for future growth. Remember that this is not financial advice and you should always do your own research and make informed investment decisions. That was all for today. Let us know if you think the stock will make you rich or not in the comment section. Hit like and subscribe to our channel $1 World for more such penny stock videos, and we will see you in the next one.